With early reaction, I'm pleased to say, joining us now is Peter Cecchini of Axonic Capital, JPMorgan's Elyse Ausenbaugh, and Keith Lerner of Truist Advisory Services. Elyse, let's begin with you. Your reaction, please, to the early inflation print from 30 minutes ago.
Sure. So I don't think that this changes much for the Fed. Tapering is still imminent, and the narrative is still very much that inflation is going to be transitory. We expect these 4 to 5% prints to moderate back down to more moderate levels by the end of next year. And I think the Fed can still look to these measures like longer-term common inflation expectations to have some confidence that they can stay on hold and be patient while the labor market plays some catch-up. So.
Keith Lerner, your reaction, please. Keith.
Yeah, I think this is likely showing we're at peak growth as far as inflation, but inflation is likely to stay somewhat high. Don't forget, Jonathan, the numbers are still 5% year over year, but if we have above trend growth into next year, these inflation numbers will likely stay somewhat high, but they are going to moderate. And I also agree that taper likely starts in November or December. But it's also important to realize, even if we taper, the Fed's still going to be adding probably about $300 billion of liquidity until the taper's done.
Peter Cecchini, you, sir, your reaction.
Yeah, I don't think this changes much of anything. I mean, the headline, it's a headline win for the transitory camp. But as you know, Jonathan, I sort of object to the phrase transitory. Inflation is almost always transitory. It either ends because the central bank decides it's going to end by raising rates, or it kills itself. And by that, I mean it kills off the demand piece that caused inflation. And other parts of the inflationary story have not changed at all. Supply chains remain disrupted. We're looking at aluminum at $3,000 a metric ton. And even lumber, which is the poster child for the transitory, in quotes, argument, is still almost 40% above where it was on average in 2019. So I don't think this print changes much at all.
This equity market likes what it sees in the early part of this morning, though. Equity futures up 1/3 of 1%. The Russell to small caps advancing 0.5 of 1%. The Nasdaq 100 futures up 50, advancing there 0.33%. At the market desk on Bloomberg, economic editor Michael McKee, digging through the numbers. Mike, do you think the chairman will like what he sees this morning?
He'll definitely like what he sees this morning, but Peter Cecchini makes a good point. Why did the numbers roll over? That's going to be the key to what the Fed decides going forward. You look at all of the numbers, they come in lower than the economists had forecast and lower than the prior month, especially looking at the core rate. That was a big surprise, just up 1/10 on the month. That had been driving expectations of the Fed maybe having to move a little bit earlier. The transitory numbers that everybody's been following for quite some time are the ones that really fell off here. And you can see in the chart how airfares and used car prices, lodging away from home, they all dropped significantly. Is that because demand fell off? Now, there's a question about new cars. They can't get chips, so they can't make more cars, but sales have dropped a lot. So it looks like even if there is a shortage of cars, the manufacturers can't raise prices. Used cars, we mentioned, down 1.5%. Airfares down 9.1%. Gasoline, though, up 2.8%. That was one of the bigger increases, and we'll have to keep an eye on that because obviously prices are going up. Now, it's not in the core, but people keep an eye on it. And shelter costs didn't really do anything, 0.3%. That's what we've been seeing over the past couple of months, even though home prices are way up. The one question people had is, are labor costs going to make it into the CPI? And it doesn't look like they did. You can see the blue line in particular. That's restaurants. Restaurants up 0.4%, which is a reasonably healthy gain. But compared to the last 4 months, it is a drop-off. So it looks like at this point, either people aren't going out, and so they can't raise prices, or they're not having to raise prices to cover margins. And the answer to that question is going to be key to the Fed.
Mike, let's build on this a little bit more. This was from Jens Nordvig in the last couple of moments. He joined us a little bit early this morning on TV and radio. The broadening is really quite a bit more important than what we see in used car prices month to month. Is that what you're getting at as well?
Yes, I mean, we are seeing prices rise a little bit more broadly, but not by a lot, not enough to worry the Fed, and they were offset by these declines this time. So we have to see where we go from here, but the Fed is, you could say at this point, probably on track to continue with the idea of a November announcement and a December start to tapering.
Mike, thank you. Elyse, you touched on it briefly. Let's build on it a little bit more. September 22nd, a Fed meeting. What are you looking for from that meeting now?
Sure. We're definitely going to have a close eye on any guidance around tapering. That said, I think it's going to be really hard for the market to be surprised by something that they can see coming from a mile away. Otherwise, we'll be closely monitoring what any forward guidance is in terms of rate hike expectations. For now, we don't think that those are going to come any sooner than 2023. But again, this inflation and, of course, the labor market parts of the equation are going to play a big role in that.
Keith Lerner, same question to you, Keith.
Yeah, I think we'll be looking for confirmation of what we've been hearing and seeing from different Fed governors and presidents that the taper is going to move forward. They set up the market. There's no reason at this point not to move forward. So we think we will see that transition as a whole. And also just bringing this back to the equity market, if you remember in 2014, we tapered that entire year and markets were up about 10%. So I think this is something the market can certainly digest.
Peter, I'd love your view on this and not on the Fed. That's the conversation we nearly always have in this market. We take the inflation point, the data point, whatever it is, payrolls, then we push it through this debate about what the Fed will or will not do. You think the biggest variable right here is the fiscal decision that still hasn't been made. Walk me through that thinking, Pete.
Yeah, Jonathan, I do. There are two things typically, and inflationary bouts like we're experiencing now are very unusual in history. And post World War I, post World War II, the 1970s, there were two commonalities. The first was large deficit spending, which often lead to a private credit boom, and supply chain constraints of some sort or other. And we've had approximately $6 trillion in stimulus thus far. Most of that, Jonathan, has made its way through the economy. We can see that in the drawdown on the Treasury General account. We can see that in the depletion of excess household savings. So there are lots of things that point to the fact that fiscal stimulus has made its way through. And without the additional 3.5 trillion coming through, which it may not, in fact, giving the resistance amongst even some Democrats, that inflationary impulse due to the fiscal policy driver may actually start to fade. And that fall in inflation wouldn't necessarily be a good thing, because it would mean that the demand impulse is falling and that the corporate credit impulse and the private credit impulse is fading. And that would be a bad thing overall, I think, for the real economy as well as for risk assets.